Lesson 2. How to raise the right amount of capital. Not knowing how to raise the right amount of capital can lead to either underfunding or overfunding, which in reality isn't as good as it sounds. What is the right amount of capital to raise? So it's not a one-size-fits-all answer, and the amount of capital needed will obviously vary from startup to startup, but it will depend on several factors including the stage of the startup's burn rate, the startup's growth plans, the market conditions, and the startup's valuation. If it's a seed-stage startup, it will likely need less capital than an early-stage startup because it's still in the early stages of development and isn't generating significant revenue yet. On the other hand, an early-stage startup may need more capital to expand and grow its customer base. Next, let's talk about burn rate. A startup's burn rate is how much money it's spending each month. So if a startup has a high burn rate, it will need to raise more capital to keep running. If a startup is planning to grow rapidly, it will likely need more capital than a startup that's growing at a slower pace, because the fast-growing startup will need to invest more in marketing, sales, and other areas to support its growth. If investors are interested in funding startups in said industry, it will be easier to raise capital because there will be more investors interested in investing in startups, and they may be willing to offer more promising terms. Let's take the tech industry as an example. During a tech boom, investors may be willing to invest more money in tech startups, and they believe the industry has strong growth potential then. But during a tech bust, most investors wouldn't want to invest in tech startups. So it's important to consider the industry when evaluating the market conditions. Lastly, the startup's valuation. A startup's valuation is the value that investors have placed on the company. A high valuation will make it easier to raise capital because investors will be more likely to invest if they believe the startup is worth a lot of money. However, a low valuation will make it more difficult to raise capital because investors will be less likely to invest in a startup that they don't think is worth much.